Okay, exam prep time. We're going to break down one of the absolute cornerstones of corporate finance, Myers and Majluf, 1984. Think of me as your TA here. My only job is to get you ready to crush this on your test. So let's dive right in. So let's kick things off with the big puzzle the paper tackles. A company says, hey, we're going to raise money to fund a great new project. That sounds like good news, right? But what actually happens, more often than not, is the stock price tanks. So why does the market react badly to what seems like good news? That is the core question. Here's how we're going to unpack it. First, we'll look at the root cause, what we call the information gap. Then we'll see how that creates the equity lemons problem and leads to a really dangerous underinvestment trap. After that, we'll talk about the solution, the financial pecking order. And finally, we'll wrap up with the key takeaways for your exam.
All right, section 1, the information gap. You absolutely have to get this part because everything else in the paper is built on this one single idea: asymmetric information.
So picture this. You've got two groups of people. On one side, you have the managers, the insiders. They know what's really going on. They know the true value of the company's assets, we'll call that A, and they know the real potential of new projects, which we'll call B. But on the other side, you have investors, the outsiders. They don't know the specifics, they just have a general idea, an average guess of what the company's worth.
And that imbalance, right there, is what we formally call asymmetric information. It's a super simple concept. One side knows more than the other, but trust me, it's the engine that drives this entire theory. It changes everything.
Okay, so here's where it gets tricky. We assume that managers are doing their job right, which means they're trying to make the current shareholders as rich as possible, the people who already own the stock. Now, that sounds great, but it creates a huge conflict when they need to sell new stock to new people. Why? Because selling new shares might mean watering down the value for the very people they're supposed to protect. And that conflict leads us straight to Section 2, the equity lemons problem. If you've heard about the market for used cars, this is the same idea applied to finance. That information gap we just talked about, it turns the simple act of selling stock into a really powerful and really bad signal. So, put yourself in an investor's shoes for a second. You know the managers know more than you do. So you ask yourself, would a manager who's loyal to their current shareholders sell me new stock if it was a great deal? No way. That would be giving away value. So when would they be eager to sell me new stock? Well, when they think it's overvalued. And just like that, the announcement itself becomes a signal that management thinks the stock is too expensive.
And hey, you don't have to take my word for it. The paper itself puts it bluntly. They say the news that comes with a stock issue is, at best, less good, and at worst, just plain bad.
So this is really the key. That price drop we see in the real world isn't some irrational panic. It's the market being perfectly rational. The announcement reveals the manager's hidden belief, hey everyone, we think our stock is a little pricey right now. The market hears that loud and clear and adjusts the price down accordingly.
Now, this whole signaling problem leads to something even more serious, and it's one of the biggest insights of the paper. Let's get into it in Section 3, the underinvestment trap. Okay, this is wild. Imagine a company has a great project, a clear winner with a positive NPV, but the market currently undervalues the company stock. If they issue new stock to fund the project, they'll have to sell it cheap. So the manager does the math and realizes that the wealth they'd be transferring to new shareholders, that's the dilution cost, is actually more than what the current shareholders would gain from the new project. What do? They pass on a profitable project.
This is a massive market failure. A good value-creating project dies, not because the idea was bad, but because of an information problem. The paper says it perfectly. The cost of selling shares on the cheap can just be too high, making it better to do nothing.
So how do you get out of this trap? The answer is something called financial slack. You can just think of it as a safety cushion, a pile of cash, or the ability to borrow money safely without any drama. Slack is incredibly valuable because it lets a company say yes to good projects without ever having to go to the stock market and face that lemons problem. So all of this builds to a pretty logical conclusion, right? If issuing stock is so problematic, how should a smart firm fund its operations? Well, that brings us right to our fourth section, and one of the most famous ideas in all of finance, the pecking order.
The theory says that firms don't just pick financing methods at random. They have a clear preference, a hierarchy. First choice always is to use internal funds, that financial slack we just talked about. No information problems there. If they run out of that, they'll turn to debt, starting with the safest kind first, and only as an absolute last resort, when all other options are exhausted, will they even consider issuing new stock.
And yeah, the paper is crystal clear about this. Its model directly predicts that when companies have to look for outside cash, they're going to choose debt over equity. This isn't just a coin flip. It's a smart, strategic move to avoid those information costs.
So why debt? Why is it safer? Well, think about what each security cares about. Debt holders just want to know one thing. Can you make your payments? They're not that concerned with whether your secret new project is going to be a billion-dollar success. But equity holders, their entire value is tied to that future upside, the very thing the manager has secret information about. So issuing equity reveals way more information than issuing debt does.
Okay, let's bring this all home. For your exam, you need to boil all of this down to the 3 absolute must-know lessons from this paper.
Here's your cheat sheet. Number 1, issuing stock is bad news to the market because of that information gap, and that's why prices fall. Number 2, to avoid this, smart firms follow a pecking order, always preferring to use their own cash first. And number 3, that makes financial slack super valuable because it prevents a company from making the terrible mistake of passing up a great project.
And that's your study guide for Myers and Majluf. So let me leave you with one final thought to chew on. This paper was written back in 1984. Think about all the things modern companies do: stock buybacks, detailed earnings guidance. How much of that is just a new, more sophisticated way of trying to solve this exact same fundamental information problem? Keep that in mind. Good luck on the exam.